Ethan signs an insurance application and commits $1,000 a month. Daniel opens a brokerage app and sets up the exact same $1,000 a month. Same day, same amount. Same goal, build real wealth and protect the people they love. 30 years later, one of them has over $800,000 more than the other. And the one who came out behind? He thought he was the responsible one the entire time. Ethan is 32, works in tech, earns $90,000 a year. He just had his first kid and something shifted. He doesn't want to gamble with his family's future. He wants certainty. He wants a plan that protects them if he's gone and grows quietly if he's not. An advisor he trusts shows him a whole life policy, a permanent death benefit that never expires, a cash value that's guaranteed to grow and can never go down, tax advantaged. Be your own bank, the brochure says. To Ethan, it sounds like everything a responsible father is supposed to do. He signs up for a policy with a $1,000 monthly premium and feels for the first time in months like he has it handled. Daniel is also 32, same city, same income bracket, same new baby, same $1,000 a month to work with. But Daniel reads obsessively, and everything he read pointed the same direction. Buy a cheap term policy to cover the family, invest the rest, keep fees near zero. Let time and compounding do the heavy lifting. So Daniel buys a 30-year term policy with a $1,000 death benefit for a healthy 32-year-old that runs him roughly $60 a month. Then he takes the other $940 and sets up an automatic monthly purchase into a low-cost S&P 500 index fund. Then he closes the app and goes back to work. Ethan tells his family he bought whole life. They nod approvingly. It sounds safe, it sounds grown-up. Daniel tells his family he bought cheap term insurance and put the rest in index funds. They worry he's being reckless with a newborn at home. That difference in how it feels is going to cost one of them a significant amount of money, and not the one you'd expect. For the first year, Ethan looks like the careful one. His policy is active from day one. If something happened to him, his family would receive the full death benefit immediately. His statement says he has permanent coverage and a cash value account that will grow, guaranteed, for the rest of his life. It feels solid. It feels like ownership. Daniel looks fine. His $940 a month bought shares that are worth a little more some weeks and a little less others. His term policy protects his family for the same $1 million, but there's no account building inside it. It's pure insurance. It feels like he's renting protection and gambling the rest. But here's what Ethan's first year actually looks like when you open the envelope. Ethan paid $12,000 in premiums in year one. His cash value at the end of that year? On a typical whole life policy, close to zero, sometimes a few $100s. The first year's premiums are largely consumed by the agent's commission and the cost of insurance. Read that again. He put in $12,000, and if he tried to walk away, he might get back almost nothing. That's not a glitch. That's the standard design of the product. Meanwhile, Daniel's first $11,280, that's $940 a month for 12 months, is almost entirely invested in working, minus an index fund fee so small it's a few dollars a year. His family is just as protected by the term policy, and every dollar he didn't hand to an insurance company is now compounding for him. That's the number most insurance presentations quietly don't show you, what the first few years actually cost. Before we go further, I need to give Ethan something back, because the early cost story isn't the whole story. And if I don't show you this next part, I'm not being honest with you. Whole life has real strengths, and most index fund videos skip right past them. 1. The death benefit never expires. Daniel's term policy covers him for 30 years and then it's gone. If Ethan lives to 90, his family still collects. That permanence has genuine value for estate planning. 2. The cash value is guaranteed and stable. It does not drop when the market crashes. For someone who truly cannot stomach watching a balance fall, and who would otherwise panic sell at the worst possible moment, that stability isn't nothing. It can be the difference between staying invested and blowing up the plan. 3. The tax treatment is real. The cash value grows tax-deferred. Ethan can borrow against it without triggering a taxable event, and the death benefit passes to his family income tax-free. For high earners who have already maxed out every 401(k) and IRA, a well-structured policy can be a legitimate additional tax-advantaged bucket. 4. It enforces discipline. The premium is a bill. Ethan has to pay it or lose the policy. Daniel has to choose every single month not to skip his investment and spend the money instead. Plenty of people never make that choice consistently. The force structure is a feature for them. These are the reasons whole life creates real value for the right person. And it's the reason this comparison is never as simple as the thumbnail makes it look. But every one of those strengths comes at a price. And the price is the entire question. Quick pause. If you're the kind of person who likes honest math that most finance channels avoid, go hit subscribe right now. We do this kind of deep dive every single week. It takes 2 seconds and it genuinely helps the channel. Okay, back to the numbers. By year 10, here's where they actually stand. Ethan has paid $120,000 in premiums over the decade. A typical whole life policy's cash value at year 10 has roughly caught up to total premiums paid. Call it somewhere around $110,000 to $130,000. After 10 years and $120,000, he's approximately back to even on the cash value side. He also still has his death benefit, and that has real worth. Daniel paid the same $120,000 total, about $7,200 of it into term premiums over 10 years, and roughly $112,800 invested. At a long-run historical average around 8%, that invested money is worth approximately $165,000 to $175,000 at year 10. His family carries the same $1,000 of protection the entire time. Let's put that side by side. Ethan, roughly $120,000 in cash value, plus a permanent death benefit locked inside an insurance contract. Daniel, roughly $70,000 in liquid investments, plus term coverage that still has 20 years to run. They are not equal at year 10. Daniel is already ahead by around $50,000. And unlike Ethan, every dollar of his is liquid. But here's the honest part most index fund videos won't say. Ethan's lead in permanence and his guaranteed floor are worth something real. The gap is meaningful, but it is not yet overwhelming. What changes after year 10 is something almost nobody in this debate talks about. And it's the variable that determines the real winner. 30 years. This is the moment the entire video has been building toward. Not year 1 when Ethan looked careful. Not year 10 when the gap was real but survivable. Year 30 when the math stops theoretical and becomes undeniable. Let's build each number carefully, because this is where most finance videos either stop too early or skip the math entirely. We're doing neither. Daniel put in $1,000 a month for 30 years. That's $360,000 total. About $21,600 of it went to term insurance premiums across 3 decades. The rest, roughly $338,400, went into the index fund, dripped in steadily month after month, at a long-run historical average around 8% annually. Reinvested, never sold. That invested stream at year 30 sits at approximately $1,300,000 to $400,000. Let's anchor at $1,350,000 as our midpoint. He contributed about $338,000 of actual investment dollars. The remaining roughly $1,000 is pure compounding. He did nothing for it. It happened because time passed and he didn't panic. His term policy did its job for 30 years and then expired, right on schedule. And here's the elegant part. By the time the coverage ends, he doesn't need it anymore. His portfolio is worth more than the death benefit ever was. He has become self-insured. The need for the policy expired at the exact moment his wealth replaced it. His money is 100% liquid. He can access any portion within 24 hours. No surrender charge, no loan paperwork, no agent. Daniel at year 30, approximately $1,350,000, liquid, passive, protected the entire way. Ethan paid the same $360,000 in premiums over 30 years. A well-performing whole life policy, with dividends reinvested, typically builds a cash value somewhere in the range of $600,000 to $750,000 by year 30. Let's anchor at $720,000 as a fair midpoint for a strong policy. On top of that cash value, he has a death benefit that will pay his family when he dies, often somewhere around $12,000 or more, depending on the policy structure. That benefit is permanent. It has genuine value, and we are not going to pretend it doesn't. So on the surface, Ethan has roughly $720,000 in accessible cash value, plus a permanent death benefit. That is a real number. That is a meaningful result. He did not get nothing. But we are not done. The costs nobody totals. Here is where the insurance story quietly stops, letting you look at the receipts. First, the cash value and the death benefit are usually not both fully yours. With most traditional whole life policies, when Ethan dies, his family receives the death benefit, and the insurance company keeps the cash value. The $720,000 he watched grow on his statements was, in many policy designs, the insurer's money funding their own obligation. He could borrow against it while alive, but borrowing means paying interest on his own savings, and any unpaid loan balance reduces the death benefit dollar for dollar. Second, the opportunity cost. Every premium dollar that went to commissions, fees, and the cost of insurance in the early years was a dollar that never got to compound for Ethan. That foregone growth doesn't show up on any statement. It's invisible, but it's the single largest cost of the entire product. Third, surrender penalties. If Ethan ever needed to walk away in the first decade, surrender charges could have cost him a large chunk of what he'd paid in. His capital was effectively locked. Let's total the real drag. Daniel's term insurance gave his family the same protection for roughly $21,600 across 30 years. Ethan paid $360,000 to get protection plus a savings account bolted onto it. The difference? The premium dollars that bought him a slow-growing, illiquid cash value instead of compounding in the market is the cost that never makes the brochure. The net number. This is the number nobody shows you. Not the cash value number, not the death benefit number. The net number, after everything. Daniel approximately $1,350,000. Liquid. Fully his. Accessible in 24 hours. With term protection that carried his family the entire 30 years and retired exactly when he no longer needed it. Ethan, approximately $720,000 in cash value, valuable, but in many policies not fully accessible without reducing the death benefit and slower growing the whole way. Plus a permanent death benefit his family collects only when he dies. Daniel, about $1,350,000, working and liquid today. Ethan, about $720,000, with strings attached. That is the gap, comfortably more than $600,000, and pushing past $800,000 and once you account for the death benefit versus cash value trade-off and the lost compounding. That is what separates these two paths once you include what the sales illustration quietly leaves out. And Daniel never made a single extra phone call to do it. He just didn't hand his growth to someone else. That is the number this video exists to show you. Before I tell you who wins, I have to do something most finance videos are too afraid to do. I'm going to steelman both sides. Because the comparison I just showed you, as detailed as it was, still has blind spots. And if I don't name them, I'm just doing the same thing every other video does. Building a case instead of building understanding. What index investing ignores? 1. Behavior. The 8% only works if you never sell at the bottom. Daniel's worst year might be a 30% plus crash, and the data shows most people cannot sit through that without flinching. Ethan's guaranteed cash value never tested his nerve. If a real investor would have panicked and sold, the guaranteed product might generally have left them better off than the superior strategy they failed to follow. 2. Term insurance expires. Daniel's coverage ends at 30 years. If he's in poor health at 62 and still has dependents, a late-life child, a special needs adult dependent, he may find himself uninsurable exactly when permanent coverage would have mattered. Ethan's never lapses. 3. The estate and tax edge cases are real. For someone with estate tax exposure, a properly structured, permanent policy can transfer wealth in ways an index fund simply cannot. The death benefits, tax-free transfer, and the ability to fund a trust are legitimate tools for the small number of people who actually need them. What whole life ignores? 1. The fees are enormous and mostly hidden. The commission on a whole life policy can consume most of the first year's premium. Those costs are buried inside an illustration that shows a smooth upward line and never itemizes what was taken out to produce it. 2. The opportunity cost compounds against you for decades. Every dollar diverted from the market in the earlier years is a dollar that never compounds. Over 30 years, that foregone growth dwarfs the guaranteed return the policy advertises. 3. Buy term and invest the difference wins in the overwhelming majority of realistic scenarios. For most people, with most policies, the math is not close. The gap we just built is the rule, not the exception. Whole life is the right answer for a narrow slice of people, and it is sold to a much wider audience than that slice. Both sides have real advantages. Both sides have real blind spots. Which brings us to the only question that actually matters. Here is what 30 years of running every number honestly shows us. Whole life wins clearly when you have genuine estate tax exposure and need tax-free wealth transfer at scale. When you have a lifelong dependent who will need support after any term policy would have expired. When you have already maxed out every other tax-advantaged account and want one more. And honestly, when you know yourself well enough to admit you would panic sell an index fund in a crash, and the forced discipline and guaranteed floor are the only things that would keep you invested at all. Index funds plus term insurance win clearly when you want your family protected for the years they actually depend on your income at the lowest possible cost, when you can hold through market crashes without selling, or you build a system that forces you to, when you want your wealth liquid, low fee, and fully yours, and when you're honest that you don't fall into the narrow set of cases above, which is most people. The actual best answer for most people? Buy the term, invest the difference. Protect your family for a fraction of the cost, and let the gap between $60 a month and $1,000 a month compound in the market for 30 years. For the overwhelming majority of households, that single move is worth hundreds of thousands of dollars. The small number of people with true estate or lifelong dependent needs should still talk to a fee-only advisor, not a commissioned salesperson, and make the permanent policy prove, in writing, that it fits them. Make the product earn its place. The gap between Ethan and Daniel at year 30 wasn't really about insurance versus investing. It was about how much of your money you let someone else hold on to along the way. But here's the deeper truth that goes beyond Ethan and Daniel. Most people pick a side before they run the numbers. The insurance crowd says guarantees and protection are everything. The index crowd says fees and compounding are everything. Neither of them is lying. Both of them are leaving out the parts that make their argument look bad. The trap isn't picking the wrong product. The trap is optimizing for a feeling instead of a full picture. Ethan felt responsible every time that premium came out, and his guaranteed balance ticked up. Daniel felt nothing watching a volatile number on a screen, and a flash of fear every time it dropped. But feelings are expensive. Ethan paid for the feeling of certainty and never itemized what it cost him. Daniel almost talked himself out of the better strategy because the feeling of risk was so much louder than the math. One path gives you the feeling of safety before the math supports it. The other gives you the math before the feeling ever arrives. And over 30 years, the path you choose determines which one you end up with. So before you sign anything, or skip protection entirely, ask yourself one question. Did I include everything? The commissions, the opportunity cost of every early dollar, the difference between cash value and death benefit, the liquidity, the taxes, and the honest truth about whether you'd actually stay invested when the market falls apart. Because the answer that includes everything is the only answer that actually matters. If this breakdown showed you the numbers others won't run, hit subscribe. That is what we do on this channel, every single video. I'll see you in the next one.